It's Friday, and today I'm going to do a quick update or review for my students in personal finance at the University of Houston. It's been a crazy week because of the storm, so we did not have class, as you know. If you're a student in the course, welcome. This is going to be posted to the playlist, and you know where to find the playlist. So I wanted to just do a quick review of this week's assignment because, well, this week is a little disruptive. We didn't have a lecture. We didn't have a Zoom meeting. So I'm just going to go over a couple of things. We're going to talk about tax-advantaged investing. We'll focus on 401k plan. Remember, I talked to you about the perfect investment. That's the 401k. We'll go over that for a minute. We'll talk about Roth IRA, the only tax-free investment that I know of. And then we'll focus on a few penalties, and I'll talk a little bit about penalties and how they work. And finally, well, we'll do some plan eligibility rules just to make sure you're familiar with those. And then we'll end with some tax allocation strategies. So hopefully that will, let me get back here, that will get us through a decent review of this week's assignment for tax-advantaged investing. So let's get started. I'm going to jump into tax-advantaged investing and just do a quick review using a different tool today, as you can tell. 401k, again, this is the perfect investment that we talked about, and I explained to you how it worked. So I want you to understand it this week as you go in and update your financial plan and write capital with the 401k contributions that you're going to pretend that you've made over the last 10 years. So that's a big part of the capstone assignment. So I want to make sure you're aware of that the 401k plan is a tax deferred investment. So you should know the difference between a tax deferred and a tax free type of account. These are both tax advantaged investments, and they fall under the category of the second law of personal finance, which is the law of tax advantaged investing. The Roth IRA is the tax-free investment, and you should know about the Roth IRA. You're going to be spending a little time working on updating your plan and write capital, pretending again that you've contributed to your Roth IRA for the last 10 years. And you will get to see the impact that has on your retirement probability of success. You'll get to see that in your plan after you set up your plan and write capital. So I think that is an important part of your, let me make sure I've got the right, that's an important part of your capstone assignment, and I want to make sure you are aware of that. Tax penalties, this isn't really a big part of your assignment or this lesson for this week, but it is an important part in real life, as my grandson would say. For real life, that's like for real. Anyway, that's an important part of your understanding of these tax-advantaged investing. If you remove money early, you will have penalties, and those penalties are significant. And so in your study this week, you've been exposed to a little bit about tax penalties. And also, you'll notice that in the link below in this video, there is a link to the post. I created a post for this review. So there's a paragraph or two for each of these topics. So I hope you'll spend a few minutes and just review the post that I put in for today's review. I think plan eligibility, I did the wrong button there. Plan eligibility is something that, let me get back where I'm supposed to be. Plan eligibility is going to apply to every type of account. Remember, when we talk about tax-advantaged investing, we're talking about types of accounts. So the types of accounts that you use to manage your wealth That is really the key component of tax-advantaged investing. So we talk about different investments. We talk about asset allocation and types of investments like stocks, bonds, private equity, or we talk about asset classes, large cap, small cap, mid cap, international bonds. But that's different than types of accounts. So the types of accounts, 401k, Roth IRA, these are important things for you to understand. And each of those types of accounts has different rules for plan eligibility. So you don't have to get too deep in the weeds there, but I do hope you'll spend a little time and just understand what that means. And overall, tax allocation strategies really just means putting your investments in different types of accounts so that you take advantage of the tax code. Again, tax-advantaged investing. But tax allocation strategies really is a category for this whole topic of tax-advantaged investing. You can't use tax allocation strategies if you're not putting money into different types of accounts. Like the 401k, we talked about the perfect investment and the fact that you have a match, a company match. That's why it's the perfect investment. It's the only investment I know of, the 401k with a company match, where you get to double your investment immediately. Well, pretty much immediately. There are some rules. If you take your money out, leave and go to another job within 3 years, chances are you're not going to get the match because you will not get what's vested. So that is tax-advantaged investing, kind of an introduction. So now let's jump in and talk about 401k a little bit, tax deferred. And again, the difference between a tax deferred and a tax-free, tax deferred like 401k, you're going to pay the taxes when you take the money out. So I want you to just kind of be aware of that. And contribution limits, again, every type of account has contribution limits and they change from year to year. So just pay attention as you don't need to memorize this. You don't need to spend a lot of time just know that each of these types of accounts have contribution limits, and the 401k is no exception. Talk about a contribution, an employer contribution, the company match. That's really one of the key elements of a 401k. So you want to know before you take that job what the employer contributions are going to be. We talked about tax benefits of a tax deferred account. It's basically you don't pay taxes on the growth. You don't pay taxes on the gains until you take the money out, and then you do pay taxes. But you get biggest tax benefit is you get a tax deduction. So understand that. And if you look in your plan and you just look at those projections, if you want to spend a few minutes and just see how it works in terms of the potential gains, you can see those graphs in your financial plan, because the growth potential when you're investing in a tax-deferred account is significant. Because especially if you're a high-income earner, the tax deduction makes a big difference in your 401k plan or your tax-deferred investments. So again, I mentioned I turned 59 and a half not that long ago, and because of that, I can now take money out of my IRAs and my 401k. And remember, when you have a 401k and you terminate, you leave that company, you will roll that money over into an IRA, an individual retirement arrangement. So when we talk about types of accounts, when we talk about tax deferred types of accounts, 401k is a tax deferred, and so is the IRA that you would roll it into. So hopefully that makes sense. So now jumping right along into the Roth IRA, that's the tax-free type of account. And that is, again, that account has eligibility rules just like every other tax-advantaged account. So you did a little reading in Money Study Group. There's some articles and for eligibility for this type of account. Obviously, it's a tax-free type of account, so it has some limitations in terms of how much you can contribute. And also, it has some limitations for how much you can earn and still be able to contribute. So you'll see that again. And again, don't spend a lot of time trying to memorize this. Just understand and to be aware that these limitations exist. That's important. Tax advantages, again, the Roth IRA, you don't get a tax deduction. But the beautiful thing about a Roth IRA is that your money grows tax-free and not tax deferred, but tax-free, which means I have a couple of Roth IRA accounts, and the growth in those accounts, when I take that money out, I pay no tax on the growth. So that's a fantastic benefit, one of the tax advantages. There are some, again, withdrawal rules in a tax-free type of account, a Roth IRA. And so, again, just be aware of those. And there are, in the Roth IRA, there's a lot of exceptions for early withdrawals. That's one of the benefits, one of the reasons that a Roth IRA is a more attractive type of account for a lot of people. Okay, so now let's just jump right into tax penalties. Hopefully by now you know that you pay a 10% penalty if you take money out of your 401k or your IRA early. That's a 10% penalty in addition to the actual taxes that you would incur when you take the money out. Remember, you got a tax deduction when you contributed to a tax deferred type of account. You got a tax deduction. So now when you take the money out early, you have to pay the taxes that you were able to deduct. So that's early withdrawal penalties. And there are some exceptions to the penalties, but there are not very many exceptions. And again, the Roth IRA has more exceptions to these penalties than the general tax deferred types of accounts. Minimum distribution requirements. This is something you probably won't think about until you start to get older. But when you start to get older, here's what happens. You accumulate money in an account, a tax deferred or tax free account, and you eventually have to start taking money out. And if you don't, these minimum distribution requirements, which require you to take money out of your account, if you don't do that, you pay a 50% penalty. So you pay a huge penalty if you fail to take out the minimum amounts that you're required to, and that starts around 70.5. So that's one of the things that you should know about tax advantaged investing is those accounts, those types of accounts that are considered tax advantaged require you to take a minimum amount out at a certain age. It's called a minimum distribution requirement. And again, tax implications, every time you take money out of one of those accounts, it is attributed as earned income or income. So you pay taxes on it. So just know that when we're dealing with tax advantaged investing, there are always tax implications. And it takes a little planning to avoid the penalties. So that is what I wanted to kind of highlight for tax penalties. Much more information that you can learn. And plan eligibility rules, again, there are income limitations. You can't contribute to certain accounts if you make too much money. And also there are age requirements. So again, these are not things I want you to spend a lot of time memorizing. I just want you to be aware of them. Employment status is important. Like, for example, on a Roth IRA, you cannot contribute to a Roth IRA if you don't have earned income. You can't contribute to a 401k if you're not an employee of the company that has the plan. Spousal contributions is a pretty important element of these accounts. For example, I am still working. I have a business and I'm still earning income, so I can contribute to my Roth IRA account. My wife, on the other hand, who was a teacher for many years, she retired a few years ago, but she still gets to contribute each year to a Roth IRA. That's a spousal contribution, and that's because of my income. She qualifies to contribute to her 401k. To her Roth IRA. but she can't contribute to a 401k because she's not an employee in a company that offers a 401k. In fact, I'm not either. I own my own company, and I don't currently have a 401k. But in about 5 minutes, I will have a 401k. I'm setting up a 401k. The income has continued to increase, and now it's time. The reason I'm going to do that, by the way, set up a 401k, is because when your income goes up, if you want to take advantage of tax advantaged investing, you want to deduct as much income as possible, and that's certainly what I want to do. So I'm going to set up a solo 401k so that I can take as much of my income as possible and put it into that bucket and get the tax deduction. So that's the whole idea of tax advantaged investing. Special cases, I'm just not going to say much about special cases right now because we've got way too much information already on the plate. So tax allocation strategies, what I really want you to know is in your right capital plan, that's where you want to make sure you have allocated money in each of those three buckets: the non-tax qualified account, the tax deferred account, and the tax-free account. And that was all outlined very clearly in your assignment instructions, but that's a huge part of tax allocation strategies. Tax-efficient investments, we're not going to spend a lot of time on that, but I do want to mention that we've talked a little bit about different types of investments, like a mutual fund or an index fund or an ETF, an exchange-traded fund. And an ETF, an exchange-traded fund, was designed for the purpose of being a tax-efficient investment, and it is tax efficient, and there's lots of other benefits for ETFs, exchange traded funds, which is the reason that most people like myself who do professional money management love ETFs to use as part of the strategy for managing portfolios. And so that's an important part of tax advantaged investing, is the type of investment that you have inside of your tax qualified account. So I just want to plant some seeds for you as you move forward in your investing life. These seeds should grow, and they'll start to make a lot more sense later as you accumulate wealth doing the things that you're learning to do in this course. So hopefully that's helping you just develop a better understanding of these strategies. Rebalancing techniques, we didn't talk a lot about rebalancing, but rebalancing is a big part of investment management. And we covered the 4 investment strategies that are designed to maximize your returns and minimize your risk. That was diversification, asset allocation, which deals with types of asset classes. And the third one was dollar cost averaging, which is the most powerful investment strategy for young folks who have a long time to invest. But the fourth investment strategy we talked about was portfolio rebalancing. And it's a huge, very important part of tax advantaged investing. So be familiar with that and continue to learn more about that. Withdrawal strategies isn't something we're going to spend a lot of time with, but I promise you, if you were a client and you were getting close to retirement, withdrawal strategies, that's a huge part of retirement planning in general. It's a huge part of tax advantaged investing. Which accounts you withdraw money from is a huge part of managing your cash flow and therefore also managing your taxes. Tax loss harvesting, we really haven't talked a lot about that, but I just want you to know that it is a thing, and you should start to become familiar with tax loss harvesting, at least in terms of a concept. It will become important to you as you move forward in your investing life. So that is that. And when the Fed cuts rates, that's another topic for another video. That's what's coming next. So that's about it for this lesson. This was just a review. I appreciate you taking some time to watch this again. This video will be in your playlist at uhplaylist.com. So I hope you're all getting along fine after the storm. In my neighborhood, we're very much Let me hit a button here and see what happens. Okay, yeah, in my neighborhood, we still have lots of generators going. We have chainsaws going everywhere. We have worker bees and more work. And I've been working like crazy. I hope, and we have electricity here in Friendswood, Texas. So I hope you do too. But I know some of you don't. And so on that note, let me just mention I'm extending the assignment due dates. They're all scrambled up right now. For one thing, it's summer school. Summer school, we have a very radical schedule of assignments and due dates. But just know you can go and check Canvas. If you don't have electricity, this is for you. If you've already completed your assignments, I'm going to be very generous in giving extra points for students who were able to get their assignments done early. And I feel like, I appreciate that. If you can't, if you weren't able to do that, you won't get penalized. You won't get the extra points if you didn't get your assignments done early. I've received lots of emails from students asking if I would extend the early assignment bonus due date, and I'm not going to do that. But those of you who can get them done early, you will get the extra points. I committed to you to do that. And those of you who can't, you won't be penalized. So I hope that seems fair. If not, you can write a letter to your congressman and perhaps they'll respond. But just kidding. I do seriously hope you're doing well. Hope you're staying safe. Hope you're comfortable with electricity. Man, you learn to appreciate utilities when we go through a season of no electric. We had no electric for a bit, and it's no fun. And so I hope you have everything you need. And I'll see you soon. We're getting very close to the capstone assignment, and we are running out of time in summer school. So I'm going to do my best to be as generous as possible in grading your assignments. I hope you'll be as diligent as possible. And I, most of all, hope that you've learned a ton this semester and continue to learn a ton about managing money. You're not going to learn it all in this course. I told you that at the beginning, but we plant a lot of seeds, and I promise you they're important seeds if you want to be successful in managing money. And the goal, the big idea of the course is to become a millionaire by the time you're 50. And if you take what you learned in this course and you practice the principles and do the things that we outlined in this course, I promise you it will not be difficult to become a millionaire by the time you're 50. That may seem like a huge goal, but it's not. $1 million by the time you turn 50, for most of you, is not going to be a significant amount of money in the big picture. Because of inflation and the cost of living, that's just true. But nonetheless, I think it's a good goal. It's better than the alternative to not be a millionaire by the time you're 50. So if you have questions or you need help, remember, just reach out. If you need a tutorial on the capstone assignment, I've sent you instructions already in Money Study Group for how to request that tutorial. I look forward to putting those together for you. Thanks for watching the video. I'll see you next time. Now, if I can find the finish button.